Hello, I am Maurice Gravier. Welcome to our quarterly investment update. I will start with a quick look back at the first quarter before sharing with you our views on the current situation and of course our recommendations. Let's start with Q1. COVID-19 became a global pandemic, causing severe economic disruption and a market crash. Global equities lost up to 35% before partially recovering at the end of the quarter. All major asset classes were in the red, except the most defensive: gold, government bonds and cash. We hadn't anticipated the pandemic. It took us weeks to understand the threat. Once we did, based on our valuation discipline, we significantly cut our exposure to equities, taking profits in February and keeping the proceeds in cash. We bought them back 25% lower in March in the middle of the crash. As a result, the performance of our three investment profiles are respectively -6%, -10% and -15% in Q1, getting better as I speak in April. We haven't given back all the gains of last year, but it's still obviously negative. However, we have delivered on our key promise to you, which is to protect your assets better than competitors in difficult times and to be as good as them when markets rally, as we did last year. Now, our views. Performance recovery requires three conditions to be met. First, of course, the pandemic itself has to be under control. Our assumption is that most of the restrictions will be lifted by the summer. It is the necessary catalyst, but it is also the biggest risk. Second, in the meantime, policy responses have to avoid both a financial crisis and irreversible damage being done to the economy, mostly permanent job destructions. Job losses are big, but responses, it's the good news, are massive, with unprecedented levels of liquidity, credit and fiscal stimulus. Third condition, market valuations have to be reasonable and take into account the risk, not just betting on a V-shaped recovery. Things are moving rapidly on that side, and as I speak, the picture is mixed. There is fundamental upside only in selected areas. So, what to do? First and foremost, it is time to do a portfolio sanity check. Update your investment goals, your personal situation and risk so that you can define your real investment horizon. If it is short, don't take any risk. Volatility is here to stay and it could get worse before it gets better. For the long term, however, the good news is that for a well-built, diversified portfolio, expected returns are very decent. Between short-term uncertainty and long-term confidence, we are now neutral on the major asset classes and express our convictions within them. In fixed income, we favor investment-grade corporate bonds made attractive by the Fed backstop, as well as quality emerging market issuers. Emerging Asia is our favorite region in equities, with secular growth drivers and reasonable valuation. Both India and China are compelling for the long term. Within alternatives, we are back to overweight in gold. At a time when the world is creating trillions out of thin air, gold is the currency you cannot print. Our last advice is not a financial asset, it is a mindset. We are in uncharted territory with extreme market moves and we have to adapt. Not by speculating on the short-term direction, not by buying the most bombed out assets. Volatility creates correlation, and correlation gives you the opportunity to buy the quality at the price of crap. Selectivity as well as progressive investing is part of the winning playbook. As you know, Emirates NBD is fully operational and we are all committed to help you navigate these extraordinary times. You will find more details in our publication and we are here for you. Stay safe, invest for the long term, and together we will conquer.